Hey, what's up, guys? Sam here, and I'm going to be kicking off the noon Q&A session for July 6th, 2023. Thank you, Mirza. All right, looks like they have us scheduled for a little bit of a free-for-all today with some Q&A. So we'll go as long as you guys have any Qs. Hopefully I have some As. And it's an interesting day to do it, certainly. First little pullback that we've seen that's meaningful in some time. So we'll see if it instantly recovers, as we've gotten used to it instantly recovering or not. One thing that I shared in the options room is that there was a lot of warning signs about this, so I'll cover them very quickly. The warning signs actually started yesterday. So one of the major warning signs that I saw was actually right over here in the VXX. I've been using the VXX as an internal more so than the VIX or the VIX futures, just because the VXX tends to move a little bit more like an equity, meaning that it'll have a little bit more of a trend dynamic to it. And you can see that if I go back a little bit further, try to focus right here on the green line and the blue line. I'm actually just going to expand this because why not? So you see right here where the green line crosses the blue, it pretty much stays that way this entire time. And then yesterday it actually crossed positively. But from an indicator point of view, check this out. You got sell signals back in June 20th. You see these red arrows right here. And mind you, this is an oscillator, right? So it tends to move like that. It goes from extreme to extreme to extreme to extreme. So if you get sell signals there on a 30-minute chart, mind you, over the course of 2 weeks, this is from June 20th to today, you would expect some dip and then a kickback and then another signal to sell. But you didn't get that, right? You had sell signals back here in June 20th, and you basically went 15 days without anything, no signs of life. Yesterday at the open, you see how you got the white arrows? And then they try to cancel them out with those red arrows, but you see by the end of the day, you ended up with more white arrows, and you closed the day yesterday with a yellow arrow for the first time since June 20th. That was a decent sized warning signal of something to come. Now, did I expect for it to kind of flush the entire market like it did? No, but it was a definite warning signal to at least kind of review your positions and make sure you're good with them. And then over here, there was another one. And this one I'm still a little bit concerned about because the VIX signal arguably has played out. But this one has not yet fully. So we'll see if the market can rebuild itself. But if you have basically any momentum indicator, you should be able to see this. See how price goes higher? You have a high here. You have a higher high here. But you see how the indicator went lower? So price made a higher high, indicator made a lower high. That's a negative divergence, right? So usually with negative divergences, once they play out, you have this high, you have that high, and the divergence. Usually when they play out, they go back to where they started from. So arguably this was started right around 43.40, 43.30. So we'll see if that plays out. I would prefer that it does not, but that is still in play. And there's actually one more, and this one's kind of in the weeds. You don't all have to know about it, but I can simplify it even if you don't fully understand it. And it's the yield curve. So this doesn't matter until it gets to critical points. And see on the, oops. I messed up my chart. I don't know how to do this now. Well, I won't be able to show you that one. Messed up the screen. I don't know what happened there. So yield curve is at the low. So if it starts to move up, it's a little bit of a warning issue. But the main one that I would stress to you is just the VXX one, as well as the negative divergence. So we'll see if this, how far this can bounce. So far, it's bouncing relatively well. But it really hasn't run into any major resistance. I think resistance probably kicks in right around the daily 8 right here on SPX. So the daily 8 comes in right around 12, 44.12. So there'll be a little bit of a resistance zone between 10 to 12, and we'll see if it can get through that. If it can get through that, then that sets up a decent reversal. So just a little bit of a follow through there in terms of what we covered in the gold room. We covered this yesterday. Did I take my own advice? No, because I ended up buying Netflix, which is was down a healthy 14 or something earlier today. But it does behoove you to understand these signals, because although I did take Netflix in the face of the signals, I did size it smaller. So when you have warning signals, even if you want to stay long, completely fine. Just make sure that you kind of adjust your sizing. When you want to have big size is when everything is aligned, right? You want to have your chart, you have good chart structure, usually have a squeeze, early buy signals, and then you want to look at the index and make sure the index is in good standing, and then make sure that volatility through VXX is also, basically chilled out. And if you happen to have that, then you can go for bigger size. So that's my song and dance. If you guys have any questions, this is the Q&A session, so throw them in the chat. We'll go as long as you guys have questions. Good to see you win. High-low update. You'll get it on Monday. You're not going to get the two lines, so yours will only be the green line, not the green and red. The green and red one is something that I'm working on, but you're going to get one more update for both the trend oscillator as well as the high-low pro. Everything's ready to go. You'll get the email on Monday. If you happen to have TradingView, you can get you already have the early copy of it, so you can check it out on TradingView. But if you don't use TradingView, if you only use TOS, the email will be out on Monday. How do you deal with this gap and now the 3-bar island top? You just have to see how far the bounce can go. Really, that's really it. Like I'm kind of in that spot too. I didn't I didn't put on any shorts, and I'm long things like AI. I bought that yesterday. I bought Berkshire, which is fine. I mean, these are down very small. I'm down 6% on AI, on options, on calls, so that's nothing. On Berkshire, I'm down 9%, which is also nothing. On Netflix, I'm down 20%, so I'd like to see that bounce back. You're talking about the reversal up here, the kind of the island reversal thing going on. I think you just have to monitor it from the inside out, because as long as it continues to bounce and as long as it's able to get through resistance levels, then it's just a normal kind of, well, I don't want to say normal because the internals today were really ugly. There's nothing normal about the internals morning, but you just watch for it to fail at resistance. I mean, that's really what it comes down to. So for on SPX 15-minute, like I told you, the resistance levels we're kind of getting there. So right around 10 to 12. So even if it fails at resistance, let's say it gets up here to the daily 8, fails, pulls back, and holds support, then it's in good standing. If you start to see it pull back against resistance and fail at support, especially below the low of today, that's when I would think there's a bigger issue. So the bigger issue kicks in, if it fails on a kickback to the 200, or definitely if it takes out the day's low. You're talking about the 3-bar reversal up here. I'm kind of viewing this just as a gap fill, right? Because you did have this open gap here, and today's candle did serve the purpose of filling that gap. Bear with me just 1 second. Sorry about that, guys. Just it's a phone call that I had to take. Scheduling a doctor's visit. Sorry about the delay there. Yeah, so we were just covering this part here around the idea of this island reversal kind of thing up here. So far, I would continue to look at it like we've talked about. I don't see a reason why not to look at this as just a gap fill. But then also it does have to be monitored, right? Because it's not a totally kosher pullback, right? Like again, this higher high, right? Price goes up. You have a higher price and indicator down, usually will come back down to where it started. So because it gapped down so much, and it's still down 1%, it has room to bounce into resistance and then roll over. We don't know whether that will happen or not, so we do have to monitor it on something like a 15-minute chart. And the most articulate thing that I can leave you with to end the session here, although we'll keep going as long as you have questions, is 44.10 to 44.12 is going to be a big resistance zone. And then from there, if it can get above that, then you can start maybe at least challenging the opening print, right? So this bounce here, although it is helpful, right? It's bounced 23 points off the lows. It's all kind of fun and games until you can get above that wall there, right? The easy move is from here up to here. And then now, going into the end of my session here is where it gets a lot more difficult to break. But if it does break, that would continue to go higher. Why does the VXX always seem to have a stronger downward bias when the market is up? It's because it's constantly decaying. So VXX, think of like VXX as like having negative theta. So if you look at a VXX chart over the long run, it's just perpetually down. And it's also why you wouldn't want to hold it over a long sample size, right? These are just trading vehicles. Like the VXX was never at $1,200, right? Nor was it ever at $100, But what it's done is because it's always going lower, it has its decay essentially. So you can use the VIX certainly, but the reason that I brought up the VXX was because it tends to have a little bit more of a it tends to look day to day more like an equity, right? Where it actually will trend, whereas the VIX doesn't really trend as much. It just is more mean reversion. So if you look at, just to finish the thought, if you look at VXX or UVIXY, especially any of these levered volatility products, they will always look like they're going lower and lower and lower because of the decay that's built into them. Can you describe the LMT that you always talk about, what each stands for? Sure. Let's go back over here. So LMT would stand for level, momentum, and trigger. So L is level, M is momentum, and T is trigger. Let me see if I can think of an example. Let me use Berkshire. I'm sure there's probably a better example. I just can't think of one off the top of my head. So I'll just use Berkshire. AI is almost back to green, which is pretty crazy. I don't know if I would have had the guts to add to that, but that's probably the part of the market you want to be in. It's only 25 cents off, which we like that. We love that. So, for example, yeah, I'm just going to kind of show you an idealized example. I think it's probably showing you the ideal example is probably the easiest way to kind of introduce the concept, and then you can apply it more in a more complex way. But for example, let's say let's use Berg, right? So let's kind of start right here. And is there a way I can do that? So let's kind of go back in time a little bit and say that it's actually right now June 1st, right? This candle right here. So the thing to ask is, do you have a level? Do you have the right momentum? And do you have a trigger for it? So because Berkshire, even, hypothetically right here, June 1st, it did have a weekly uptrend. See how the moving averages are sloping up and they're correctly positioned? Then your buy zone in trend is usually going to be somewhere between the 21 and the 50, anywhere kind of in this box here, right? When you're in trend. So just real quick to give a point on this, you have to be in trend for this to be valid. If you're not in trend, let's say that your chart looks more like this, ignore the moving averages, and your support is always going to be the bottom of the range and the top of the range. The top of the range, you're going to have resistance, right? So your level would be the top and the bottom, whether you want to short or go long. But in trend, you can use moving averages. And just kind of broadly, I like to use kind of the space between the 21 and the 50 as kind of the level, right, to do this. So as we hypothetically look at Berkshire here in, at the end of May, early June, does it have a level? Is it near a buy zone, right? And it's right in the buy zone, right? It's right between the 21 and the 50. So we definitely have a level. Okay. Easy enough. And their levels are kind of a dime a dozen, right? Like the 21, the daily 8, the daily 200, the daily 50, a voodoo line, a Fibonacci level, a previous high and a previous low. They're kind of a dime a dozen. That's why we want to build on top of that so we're not just blindly doing something. I'll actually show you one other example here after I finish this one. But the next thing we want to look for is momentum. Do we have the right momentum to buy at that level? Because a level alone is not enough. So then we ask ourselves, okay, well, what does this look like at that level? Do we have the right momentum? I would say generally speaking, we do, right? The last signals we had were buy signals. The trend oscillator is correctly positioned. There's nothing really scary about this momentum. There's nothing that's out of place. The weekly's good. Everything's good. We get a check. Now, if we fast forward just a little bit, you see how you end up in this moment in time right here, where it all lines up perfectly, where you end up with basically the breakout pattern, right? You see it, how you have a squeeze, the trend oscillator is green above red, both above the middle, and you get this little happy green arrow that tells you to buy. That's perfect, right? So that rounds out the M part of the conversation, right? Lastly, we look at for a trigger. A trigger would just be something like a 15-minute moving average crossover. So one that I like to use is a 15-minute 2150. It's a little slow, but it's also a lot more accurate. You can use something faster. You could use a 5-minute. You could use something slower. But you just basically want to, once you have a level and a momentum setup on whatever time frame you're using, in this case the daily, then I want you to drill down into a smaller time frame to get your trigger. So if you're looking at the daily, you can use an hourly trigger. If you're looking at the daily, you can use a 15-minute trigger, but you ideally do want to see a trigger. Let me show you an example here on AMD where it kind of played out in reverse, and it kind of saved our ass when we were looking at it initially. So with AMD here, there was a point in time, and this came up in the gold room, and this is probably a good example to show you the flip side of it, where it was right here. See it right there at the 21? I'm going to zoom in just so you can see it. It was right there at the 21. Now, a lot of people would just blindly buy the 21, right? And this is why it's so important to have the LMT concept. Even just use your own indicators for this. Even if you don't have my indicators, perfectly fine. Whatever your indicators, you know what your indicators would look like when it has good momentum, bad momentum, and very importantly, sloppy or non-existent momentum. So in this case, you see how if we look at AMD with the concept of LMT, do we have the right level? Well, yeah, we do, right? It's in an uptrend. It's at the daily 21. We do have the right level. But what would happen if we bought that day and we didn't finish out the concept? If we just buy the 21 because it's in a trend, we only get 1/3 of a trade, right? Because look what happens here. Do we have the right momentum at that level? We have a level, check. Do we have the right momentum? Well, when you looked inside of it, you see what the momentum looks like? Look at all of those sell signals. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. You have like 13 sell signals there, right? So you don't actually have the right momentum from the inside out to justify buying that level. And look what ends up happening. Because I remember this came up in the gold room, and people are like, well, let's buy the 21. I'm like, well, I would buy the 21, but I need an arrow. I need something to show me that all of these 13 sell signals all through here are canceled out. And if I don't have that, then I only have 1/3 of a trade, right? I have a level, the daily 21. I do not have the right momentum, and therefore I don't have a trade. Look what ends up happening the very next day. Bang. Look what happens after that. Bang. Bang. Right? And look how long it took for that to change. You got these signals on a Monday. You didn't cancel them out until like 2 Mondays later. So I think this is just kind of hopefully crystallizes the point in terms of why you would want to combine a level, a momentum signal, and a trigger to make the best trades possible. If you do that on every trade, you're going to be a lot more successful. I can tell you that much. And if it doesn't have those parameters, then you save yourself some money and some heartache. Did I move my money out of the 401k stable fund? Thanks, Christian. I appreciate that. So Christian's using me as an opposite indicator. So you're saying when I take my money out of the stable fund and back into Alger fund, you even remember the funds, dude. You have a really good memory. Then you'll know the bear market is over. So basically, when I put my money back to work is when the bear market is over, is what Christian is saying. So Christian shows up just to see what I'm doing, and then he's going to do the opposite. I like it. I'm an inverse indicator for you. No, I actually haven't. I haven't taken anything out. So I've left it in the stable fund. I've considered it. I have considered it, but I have not done it. Much to my detriment. I mean, much to my detriment. Had I done this back in, when I got a buy signal back in March, that position would be up quite a bit. But I have not done that. My largest 401k allocation is still in the stable fund, which is just basically cash that earns interest. It's basically a money market. How many shares of Burke did I buy? I did 5 contracts of the 345s for July. So I went out of the money on purpose. Let's see if I can get a quick pop based on the daily and hourly squeezes. Now, in a better market, maybe that would be working today, but the setup is still fine. So I was trying to play this daily squeeze. You have alignment everywhere. You have this happy green boy that I showed you from March, or from May, I should say. So that's still active. Check, check. Squeeze is fine. Structure is fine. Weekly is fine. Trend os is fine. High low is fine. Structure on the hourly is fine. The squeeze here is fine. The trend oscillator is fine. And this is fine. So trying to play this combination of charts, the daily as the anchor, the hourly as the steering wheel, for lack of a better term, into a little bit of a breakout above this high, and I would plan to sell right around 345. If we had a better market, it might be working better, but we'll see. Regarding timeframes, why do we use the 195-minute for half of trading session instead of 4-hour, but for day time frames we use 2-day chart instead of something like 780 minutes? Well, the day is not, so there's how many minutes in a trading day? There's 390 minutes in a trading day, right? So if there's 390 minutes in a trading day, that's a 3, I promise. It's a little bit of a drunk 3. And you divide that by 2, you get 195. If you take 390 minutes in a day, minutes in a trading day, and you use a 4-hour chart, the first half of the day is going to be 240 minutes, right? 4 hours, 4 times 60. And then the second half of the day is going to be 150 minutes. So while you'll still end up with 2 bars per day with 4-hour charts, and I do like a 4-hour chart. In fact, on my own, I use 4-hour charts. I don't actually use 195-minute charts, although I certainly appreciate the logic. You see how you'll end up with 2 bars, but you see how the first bar is lopsided. You'll have 90 more minutes in the first bar being accounted for than the second bar. So that's why you use 300. That's why you use 195 minutes, so that the front half of the day is equal to the back half of the day. And going to 2-day and longer, I don't know anyone who uses minutes for that. So for anything longer than a day, I would just use 2-day, 3-day, and weekly. You thought the VIX was broken now? You're not alone. You're not alone. But be aware of this, if nothing else. In order for the VIX to have been this low for this long, there are institutional sellers that are leveraging up selling VIX nonstop. And today is definitely a thumb in their eye. So if you don't see the VIX come down, and the VIX is probably one of the more important signals to watch today. If you don't see the VIX come down substantially, it's going to create additional problems, because there's going to be a lot of folks that are short volatility, right? People love to pig out, and I say people, I mean institutions. They're doing it in big size. If you remember the SVIXY scandal, when that fund blew up because so many people were short VIX, and then the VIX had a huge pop. That's kind of back in vogue. So yeah, is the VIX broken? In some ways, yes, but it's also very strongly being sold by institutions. And if the VIX pops against them, like it was up 20% earlier, they then are forced to cover, essentially, which does what? They're now forced buyers of VIX, right? Which could be kind of dangerous. Unfortunately for the YouTube folks, I don't see any of your questions. So actually, maybe I do. Okay, I think I do actually see one of your questions. So it seems like the charts don't mean much when they have these economic reports come out. Tomorrow we have an economic report at 7:30. We could see a huge move either way. I would disagree with that. I showed you, if you caught the beginning part of this, and if you didn't, I would suggest you do. There was lots of warning signs yesterday that there was going to be an issue. I don't think that the idea that news creates the move is kind of silly. Like, and I say that respectfully, but it is silly. And here's why. Do you think that these hedge funds, who basically have Powell on speed dial, Powell is like cleaning the floors of Jamie Dimon's mansion, right? Do you really think these hedge funds and these super large mega banks don't have all of the data that you saw this morning early? They probably do, right? So here's the better way to think about it. News is not the catalyst. News is the accelerant, right? News is gasoline to the move that was already going to happen, up or down. But I would disagree that the economic reports are really what's driving things, because there was plenty of warning signals, right? We covered them yesterday before it even happened in the gold room. And then I covered them again in this session, if you weren't in that room to see them. You'll always see the footprints on the charts, always, right? Keep in mind, if these guys see, and gals, if they see, good economic report coming, guess what they're going to do? They're going to go buy, and it'll show up somewhere in some way. If they see a bad economic report, they're going to sell, and it'll show up somewhere in some way. I can show you one warning signal just again right here, right? So here's a pretty big warning signal, and this happened yesterday before we even got any news. We made that higher high here, right? First high, second high, higher high, significantly lower high there. Look how you closed the day yesterday. You closed the day with sell signals. So the news is more of an accelerant. It is not a catalyst. All right, last couple of questions here. Microsoft is green. No, Microsoft is an absolute animal. I'm hoping Berkshire can join that group. It's trying to climb slowly. Yeah, Microsoft talked about AI or something this morning, and so their stock is up. great pattern. I mean, just fantastic pattern, fantastic chart. Look at the buy arrows here on the. This is just perfect chart. Absolutely perfect chart. I don't have much else to say about it other than that's a perfect chart. RTX seeing some signs of life. Yeah, I got out of that one a little too early. I broke my own rule. Normally, if you're going to have something like this, this was just a weird trade because I got in on this on Friday, and then there was like that fake coup on Saturday, and I'm like, oh yeah, this is good for me. And then it was like over by like an hour later. Yeah, I broke my rule though. I got in here on that candle, and then it gapped down the next week because the coup is fake. But normally when I buy something like this, I like to have a 3-day rule. And if I had followed my 3-day rule on the 4th day, you basically recovered everything, and now you're trading above where I got in. Is this a great pattern? It's okay, but there are better patterns out there for sure. Even Berkshire is a better pattern. But if you happen to have held, you're doing better than I did. What's my momentum indicator? They're down here. It's called the trend oscillator and the high-low pro. I use them together. So far, there's no major issues. Is Apple a hold? Yeah, I don't want to do that kind of Q&A. So like, let's stick to like bigger picture other than just like, is this a good stock or not? But I'll cover Apple for sure. And if there's no other questions after that, then we'll call it a sesh. Is Apple a hold? Well, there's no technical damage to it, right? So in order for this to not be a hold, it has to break the pattern. And Apple here, the pattern has been very almost, this is almost a textbook. Like you could really just write a textbook about this. 21, 21, 21, 21, right? So it actually hasn't broken any patterns here. Are you early to this? No, I mean, it's a super, super extended, ridiculously extended pattern. But, and I'd rather be in Microsoft. I'd feel more comfortable in Microsoft because Microsoft isn't as extended, but it's the cousin of Apple and it has better signals than Apple at the time. But there's no issues here. The thing to watch here on Apple would be the hourly sell signals, right? You see how even, for the guy that said, it's an economic report, you got sell signals on Apple yesterday. And it's trying to go back into a buy signal. If you get another buy signal on Apple, it's just off to the races again. So I would say that Apple is a hold. Only because you made fun of me, Christian, will I look at your stock. You're negging of me. It's going to get me to look at your stock. Oh, wow. I hadn't looked at PanW in forever. The next hourly buy signal, you just go with it. This one's actually pretty easy because it's gonna only do one of two things. I don't know if you have the indicators or not, but is the weekly good? Yes, yes, yes. Is the daily good? Structure, trend os, high-low pro. Is the hourly good? Structure, yes. Trend oscillator, yes. You're in the middle of a sell cycle. And the thing is, you don't know if it'll play out like the ones before, where you see how once you get what you cancel it out, and then from there you make big moves. So instead of jumping the gun, wait for your arrow, and then it'll match up with everything else, and everything will be good to go. So if you happen to get an arrow on this either today or tomorrow, then yeah, this would be a buy for sure. Actually, I'm going to write it down. I'm going to keep an eye on it because this one's pretty clean. I haven't looked at this in a while. If you get a cancellation of the sell, you'll get a big move from this. So yeah, keep an eye on it. Just need a cancellation. Explain the 3-day rule. With the 3-day rule, this is just kind of a loose rule that I have for myself, but that I've found works over a long sample size. Is if you happen to be in a stock where there's just some random event that happens, it's outside of the stock, that's like stock specific, whether it's like bad news, insider selling, or just something specific to that company that causes like a gap down. Give it 3 days. And if by the fourth day it does not recover, it's an automatic cut, and you can even turn around and sell it and short it. And that happened with Raytheon. So Raytheon, I got in on Friday. I thought I was the luckiest guy in the world because there was a Russian coup on Saturday, and I'm long Raytheon, which is probably a pretty good thing to be. By Monday, it was all cleared up, and Raytheon gapped down. Right. Monday it gapped down, did nothing. Tuesday it did nothing. Wednesday it did nothing. Thursday, day 4, it had a huge pop higher and recovered everything. So that's basically the idea. That only applies if you have like news that hits the stock, though, right? It has to be like externally driven. All right, guys. Well, that might be close to it. I'll close with do I have a strategy for AI? Not really. I kind of just am using the index as a proxy for it. So we'll close with AI, I suppose. I've already gone over my time, but a lot of it was spent on the phone with the doctor. The thing is with AI here, I get that this is kind of an ugly pattern, and it might very well play out, right? Like you can kind of look at this kind of like a little head and shoulders thing going on here, maybe. But I've also seen these patterns not work, right? Whenever I see a head and shoulders, I can actually show you an example. There's one right here on the SPX. See it? And it actually started breaking the neckline, and then look what happened. Boom. So if you understand that these patterns, the more obvious they are, the less likely they are to work. That would be kind of the bearish take on it, but the bullish take would be that it's basically already turned around and is ready to go. So as long as the index does not have any issues here, like basically my entire book, which is AI, Berkshire, and Netflix, as long as the index, the SPX, continues kind of chewing back at the ground that was lost, I hold everything. And if it stops chewing back, let's say that what I told you is not acceptable. So it's at resistance right now. It's been at resistance this whole time I've been talking. If it comes back here, I would more than likely cut it. Right? If it fails back at basically 43.95. So it's the index is allowed to actually fail here, come back and do that. In the most extreme cases, it's allowed to fail here, come back down and do that. But it's not allowed to break some of these structures anymore. So that's the strategy for AI. I'm trading everything based on the index. It doesn't look bad though. I would actually consider buying it here. So, all right. Well, that is my time, guys. I appreciate your questions. Hopefully, this was helpful to you. Mostly, the conversation we had around LMT is probably the major takeaway. Even if you don't have my indicators, perfectly fine. Just apply those concepts using your own indicators: level, momentum, and trigger. And if you can apply those 3 concepts universally to every trade that you do, I think it's going to increase your win rate tremendously. So, hopefully, that was helpful to you. And for the YouTube folks, thanks for being here. See you guys next time. Have a great day. Cheers.